prices. Is next year going to be better?
Well, we think munis will outperform other fixed income products next year, but we'll be stuck with a rising interest rate environment. We will follow Treasuries. Our current call is for Treasury, the 10-year Treasury, to be at a 360 by the end of the year, and the muni 10-year will be following that. But our ratios will come down as we go throughout the year, so we'll be outperforming.
Now, you recently put out an outlook on issuance for next year. You forecast a 12% decline in new issue volume. Is that solely due to the expectations of rising interest rates?
Pretty much. I mean, we break our new issue forecast up into new money bonds, bonds for new projects, and then refunding bonds. So we think that the new money component will be up a little bit. It's because of a modestly improving economic environment and some pent-up demand. So we're calling for new money bonds to rise from about $160 billion this year to about $185 billion next year. So that's where the increase comes from. The big decrease comes from refunding activity. We think refunding activity will drop from about 160 this year to about $100 billion next year.
And that's simply because what had to get done on the refunding and did get done this year?
Well, it's two things. One is a rising interest rate environment, which will make a lot of those refinancings uneconomical, strip the economics out of a lot of those refinancings. But also, the pool of refunding candidates for next year is a lot lower than you would expect, and that's because we've had such low rates over the last few years that a lot of those bonds that could have been refunded early were in fact refunded early, so a smaller pool of candidates.